So, I want to start this off with the statistic that honestly just kind of breaks my brain every time I think about it. Warren Buffett made like 99% of his $100 billion fortune after his 65th birthday.
Right. Which is just wild to think about.
Yeah, it really is. I mean, he's been systematically, slowly compounding this wealth for nearly 80 years. But then, on the exact opposite end of the spectrum, you have a 24-year-old tech founder who can write a piece of software in a dorm room, right? And they distribute it globally over the internet in a matter of days.
And suddenly they build $1 billion company in like
Yeah,
12 months.
exactly.
Yeah, it's a profound contradiction, honestly, because you're essentially looking at two entirely different physics engines for generating extreme success.
Right.
One requires this near infinite patience, a timeline that literally spans a human life.
Yeah.
And the other just completely relies on immediate, unprecedented scale and speed.
Yeah. And I feel like the instinct for most people, when they're trying to figure out how the world works, is to just pick one of those camps, you
Yeah.
know? You either follow the tortoise or you follow the hare.
Right, you choose a side.
Exactly. But we are actually taking a completely different approach today. We're welcoming you to the inaugural edition of a new investigative series we're doing on this deep dive, and we are calling this framework the Nexial Theory.
Yeah, and just to define that really quickly, the term Nexial comes from this idea of finding intersections.
Mhm.
So it's about looking for the hidden connective tissue between entirely different disciplines or philosophies.
Right, so we are acting as researchers here, and our source material for this investigation is basically this massive stack of raw transcripts, speeches, shareholder letters, and writings, and we're pulling from four vastly different financial and entrepreneurial minds.
Vastly different is almost an understatement.
Seriously. I
Uh-huh.
mean, first, as we mentioned, we have Warren Buffett and his designated successor, Greg Abel, so the titans of the Berkshire Hathaway conglomerate.
Right.
Then we have Morgan Housel, who is this deeply historical, really behaviorally focused finance author. We have Naval Ravikant, the Silicon Valley philosopher, angel investor, tech theorist.
Oh, and don't forget Alex Hormozi.
Right, Alex Hormozi, who is just this high-octane expert in direct response, sales, and really aggressive business scaling.
And I think it's difficult to overstate how fundamentally these four disagree on like just the mechanics of a normal workday.
Oh, totally.
I mean, they disagree on how many people you should hire.
Yeah.
They disagree on what you should even focus your attention on. And they completely disagree on the speed at which you should move.
Right, which makes this so interesting.
Exactly.
Mhm.
So we're treating this material not as some source of motivation, but really as a documentary investigation into the underlying math of human behavior.
Yeah, and so for you listening, the core question we are trying to answer for you is basically this. If you strip away the specific industries, the differing personalities, and, the specific eras in which they started,
Superficial stuff.
right, the superficial stuff,
No.
what are the absolute, undeniable truths that they all agree on? Like, what is the shared architecture of long-term wealth and clear decision-making?
And to find that architecture, I mean, you really have to start with the foundational tools of construction.
Okay, lay it out.
Well, when we cross-referenced all four of these thinkers, the absolute most universally agreed upon concepts, like the bedrock of their entire worldview, is leverage.
Leverage.
Yeah. Basically, if you do not understand leverage, you're playing a linear game in a nonlinear world.
So I want to break down the actual mechanics of what leverage is for a second before we get into how they all use it, because I think people hear that word and just think of debt.
Oh, sure. Yeah. People think of margin trading or taking out a massive loan.
Exactly. But think of leverage more like the gear system on a high-performance bicycle. So if you're riding a bike with no gears, just like a fixed single-speed setup,
Which is miserable, by the way.
totally miserable, your output is strictly tied to your physical input. Your legs are spinning frantically, you're sweating, your heart rate is just completely maxed out, and you are maybe pushing 10 miles an hour.
And if you encounter a hill, I mean, that linear effort completely breaks down. You just stall out.
Right. But if you have a sophisticated gear system, you just shift into the optimal gear, and suddenly the exact same physical input, like the exact same downward push of your leg.
It propels you at 30 or 40 miles an hour.
Yes, leverage is the gear. It's basically the mechanism that separates your effort from your result.
And Naval Ravikant builds this really brilliant historical taxonomy of these gears. He looked at how humans have applied leverage over centuries and kind of categorizes it into fundamentally different eras.
Okay, walk us through that.
So first, he identifies what he calls permissioned leverage. And this basically consists of labor and capital.
Permissioned, meaning you literally need someone's permission to acquire it.
Exactly. I mean, if you want labor leverage, other human beings have to consciously agree to follow your direction and work for you.
Right.
And if you want capital leverage, a bank or a venture capitalist or, the public marshals, they have to physically give you permission to use their money.
And Naval points out that for the entire 20th century, capital was the dominant, supreme form of leverage.
Oh, absolutely.
Yeah.
The titans of that era, like the bankers, the politicians, the massive asset managers, they were the ones moving huge sums of money. And the thing is, capital scales beautifully.
Because managing a billion-dollar fund doesn't really require vastly more physical calories than managing a million-dollar fund.
Exactly, but the output is exponentially larger.
But Naval argues that we are no longer in the era where capital is the ultimate gear, which brings in his concept of permissionless leverage,
Yes.
which is code and it's media. So software, algorithms, podcasts, YouTube videos, writing.
And the defining characteristic of this permissionless leverage is the zero marginal cost of replication.
Okay, break that down. Walk me through the mechanics of zero marginal cost.
Sure. So if you build a physical product, let's say you manufacture a chair, every additional chair requires more wood, right? It requires more labor, more shipping costs. There is a tangible marginal cost to every single unit.
Right. You can't just copy-paste a chair.
Exactly. But if you write a piece of software, or, if we record this audio deep dive right now, the cost of delivering it to one person is functionally identical to the cost of delivering it to 10 million people.
Because the servers just handle the distribution at practically zero cost.
Precisely. You don't need anyone's permission to write the code. You don't need a loan from a bank to record a video on your phone.
Right, which is why Naval observes that this new wave of extreme wealth, like the tech billionaires or the massive media personalities, they are entirely built on permissionless leverage. They create assets that work while they sleep.
Yeah, they've completely detached their input from their output.
But let me just bring this down to the reality of the listener for a second.
Oh.
Because, say you're sitting in traffic right now commuting to a middle management job.
Right.
You probably don't know how to code. You aren't going to start a viral YouTube channel today. And you certainly don't have $1 million in capital leverage sitting around. So how does this theoretical taxonomy actually apply to, a normal person?
Well, that is exactly where Alex Hormozi's framework becomes incredibly useful.
Yeah.
Because he approaches leverage not just as a high-level philosophy, but as a really practical operational sequence.
Right. He makes it a math problem.
He does.
Yeah.
Hormozi uses this foundational equation for business. Supply plus demand multiplied by leverage.
So how does supply and demand interact with that leverage multiplier in practice? Like, give me an example.
Okay, think of supply and demand as the engine block. You have a market that wants something, so that's the demand, and you have the ability to provide it, which is the supply. Let's take that listener sitting in traffic. Suppose they're a freelance accountant. The demand is small businesses needing tax help. The supply is the accountant's brain.
Makes sense.
But if they're just doing one-on-one consulting, they have supply and demand, sure, but their leverage multiplier is essentially just one. They are trading 1 hour of their life for 1 hour of pay. They are literally stuck on that single-speed bicycle.
So how does Hormozi actually suggest they shift gears?
Through a specific sequence of stacking levers. Hormozi actually charts his own entire career this way. First, the accountant hires, say, 3 junior bookkeepers.
Okay, so they've now acquired permission labor leverage.
Exactly. The accountant is just reviewing the work now, not doing every single line item themselves, so the multiplier goes up. But then, next, the accountant realizes they're basically answering the same 20 tax questions for every single client.
Ah, so they record a comprehensive video course explaining those tax strategies and just put it on their website.
Yes. They just added permissionless media leverage. Now, 1,000 people can buy and watch that course while the accountant's asleep.
The input is divorced from the output.
Completely.
Girl.
And eventually, the accountant generates so much surplus cash from the course and the firm that they just go and buy a small payroll software company.
Oh, wow. So now they've deployed capital leverage to acquire code leverage.
Exactly. Hormozi argues that the people who seem to move at blinding speed in life, they aren't actually running faster than you. They have just systematically stacked these levers so that every single step they take yields a massive result.
I mean, I follow that progression and it makes total sense. But I want to look at the absolute extreme end of the spectrum for a second.
Okay, let's do it.
Because when you zoom out to Warren Buffett and Greg Abel at Berkshire Hathaway, They aren't just stacking levers within a small business. They have literally turned the corporate structure itself into a lever.
Oh, it's brilliant. The Berkshire Hathaway conglomerate model is basically a masterclass in removing friction from capital leverage.
How so? Like compared to a normal company?
Well, normal corporations have immense bureaucracy, right? If a standard insurance company has a fantastic year and generates, I don't know, $1 billion in excess cash, they usually have to pay it out as a dividend, which immediately gets taxed.
Right.
Or they awkwardly try to buy a competitor, and then they have to deal with antitrust laws and integration nightmares, and it's just a mess.
But Greg Abel explains that Berkshire just fundamentally despises that friction.
They eliminate it entirely. Berkshire generates what they call a float, which is
Yeah.
basically billions of dollars in insurance premiums that they hold on to before having to pay out claims.
Right, because people pay their premiums every month, but they don't crash their car every month.
Exactly. And because of the conglomerate structure, Buffett and Abel can take that massive tool of capital from the insurance arm and instantly slide it over to buy an entire railroad, or a massive energy grid, or just buy billions in Apple stock.
And there's no tax event for moving that money internally.
None. There is no bureaucracy. The structure itself is the gear that allows capital to flow instantly to wherever it has the highest compounding potential.
Okay, so I definitely see the through line here with leverage across all of them. But this is where I have to introduce a massive, glaring contradiction in our source material.
Okay, let's examine the fracture.
Because if we are looking for universally agreed upon truths, the actual mechanics of labor leverage completely fracture here.
Yeah, they really do.
I mean, Naval Ravikant explicitly warns against labor leverage. He is almost hostile to it.
He hates it.
Yeah. He says managing people is incredibly messy. It requires complex leadership skills, emotional intelligence, and just constant babysitting. He literally describes having employees as being one short hop from a mutiny.
Right. Naval wants the absolute minimum number of humans involved in his wealth generation.
Exactly. But then you look at Alex Hormozi, and he preaches the exact opposite. Hormozi says that as you scale, building an army of exceptional people is the ultimate game.
He loves labor leverage.
He does. He completely believes in raising organizational standards, creating culture, and aggressively deploying elite human capital. So we have one thinker who views employees as this massive liability, and another who views them as the ultimate asset. How can both of these be foundational truths?
It's a brilliant contradiction, and the resolution actually lies in understanding what each thinker is fundamentally optimizing for.
Okay.
They're playing completely different games. Naval is optimizing for ultimate personal freedom, peace of mind, and the absolute minimization of daily friction. He wants to be a soloist.
Right. He wants to wake up, read, think, push a piece of code, or make an investment decision and answer to literally no one.
He wants the leverage without the overhead.
Exactly.
But Hormozi, however, is optimizing for enterprise value. He wants to build a 9-figure, highly operational holding company. And the reality is, you cannot build a massive physical operational enterprise with just code and media. You must deploy elite human capital.
So basically, the goal dictates the tool.
It does. But if you look closer at the underlying physics, despite disagreeing on the specific tool, they are both ruthlessly applying the exact same principle. You must divorce your inputs from your output.
Right. That's the core of it.
Whether you achieve that by writing a software algorithm that executes 1 million trades a second without ever complaining, or whether you achieve it by hiring a brilliant executive who runs a whole division of your company so you don't have to, you are breaking that linear trap.
Which brings up a really vital point for you listening right now to just audit in your own life. Because if you are sitting in an office, look up the value chain. Look at your manager, look at the director, look at the CEO.
Follow the leverage.
Exactly. Analyze who is applying leverage to your time. Because if you were receiving a steady wage, someone above you is using you as labor leverage to decouple their inputs from their outputs.
Which isn't inherently evil, it's just math.
Right. The goal isn't to become cynical or, quit your job tomorrow. The goal is to mathematically understand exactly where you sit in the physics of that machine. Because once you see the gears, you can start deciding how to acquire leverage for yourself.
Which actually serves as the perfect transition. Because if leverage is the engine that drives wealth, time is the track that the engine runs on.
Oh, absolutely.
The raw mechanics of leverage are entirely dependent on how you perceive time. I mean, if you build a massive lever but you just abandon it the moment the market drops, you have built nothing.
Which brings us to the second major theme of this deep dive, the timeline of wealth.
Right. We have to move from how wealth is generated to when it actually materializes.
And this is where Morgan Housel's work just shatters normal human intuition. We touched on it in the intro, but 99% of Warren Buffett's net worth was accumulated after his 65th birthday.
It's one of those statistics that just sounds completely fabricated, but the math is absolute.
Let's really look at that math for a second. Buffett had roughly $3 billion at age 65, which, yes, is obviously an extreme level of wealth.
Sure.
But today, he is worth well over $100 billion. And that isn't even counting the tens of billions he has already given away to philanthropy. He made almost all of his money when most people are completely retired.
And Housel provides these psychological diagnoses for why this shocks us so deeply. He points out that human brains are evolutionarily wired to understand linear math.
Right.
If you ask a person to calculate 8 plus 8 plus 8 plus 8, they will instantly tell you it is 32. We understand additive progress perfectly.
But if you ask them what 8 times 8 times 8 times 8 is, the brain just stalls.
Because the answer is 4,096.
Mm-hmm.
We just do not intuitively grasp exponential compounding.
I think the best way to visualize the terror and the beauty of compounding is the algae bloom metaphor.
Oh, that's a great one. Walk through that.
Okay, so imagine a massive pond. You introduce a single lily pad, and it has this property where it doubles in size every single day. If it takes 30 days for the lily pads to completely cover the pond, on what day is the pond exactly half covered?
Day 29.
Day 29, which means for 28 straight days, you are looking at this pond, and it essentially looks empty. You look like a fool. You're telling everyone, just wait, this algae is going to take over, and they look at a pond that is 95% water, and they just laugh at you.
Right. Nothing is happening.
Exactly. But that is what Buffett's 80-year timeline feels like on the inside. All the visible, world-altering results happen in the final milliseconds of the compounding curve.
And Housel argues that Buffett's true superpower isn't even his ability to pick stocks.
Wait, really?
Yeah. I mean, there are hedge fund managers who have achieved much higher annual percentage returns than Buffett for short bursts.
Right, like a hot streak.
Exactly. But they burn out. Or they take catastrophic risks and blow up, or they just retire. Buffett's secret is purely his endurance. He has been compounding at a steady rate through 14 presidencies, multiple wars, and just countless recessions.
Which completely redefines what patience actually means in this context. Because, when I hear the word patience, I think of sitting in a doctor's waiting room, reading a stale magazine, just passively waiting for time to pass.
And Alice Hormozi aggressively attacks that passive definition. Hormozi defines patience as a behavior, not an emotion. He says patience is figuring out what to do in the meantime.
He maps this to a conversation about courage, right?
Yes, he references a framework that's often used by military operators.
Yeah.
Basically, if you are terrified before kicking down a door, but you execute the mission anyway, that is true courage.
Right.
If you feel absolutely zero fear and you kick down the door, you aren't courageous, you just lack a fear response. And Hormozi applies that exact same logic to patience.
So if I am working on a business and I feel this agonizing sense of urgency, and I'm deeply frustrated that I'm not a millionaire yet.
Which is how everyone feels.
Right. But if I still wake up and execute the mundane daily tasks anyway, that is true patience.
Precisely. If you are patient despite feeling intensely impatient, you have mastered the behavior. It basically means executing the daily plan while actively ignoring the delayed outcome.
And we see the ultimate manifestation of that behavior in the Berkshire Hathaway transcripts. I mean, right now, Buffett and Abel are sitting on roughly $380 billion in cash and U.S. treasuries.
$380 billion yielding just a basic, safe return just sitting there.
It is unfathomable. Think about the pressure of that. You have shareholders, Wall Street analysts, financial media constantly demanding to know why you aren't deploying that capital. The friction of doing nothing must be intense.
It is the hardest thing for an operator to do. Ajit Jain, who runs Berkshire's insurance operations, he explicitly trains his executives with a very simple mandate. Your job is to say no. Yeah, the discipline required to look at hundreds of deals, to have literally infinite capital, and to sit on your hands for years is staggering. They do not swing just because the crowd wants them to. They are waiting for what Buffett calls the juicy pitch.
Right, an opportunity so profoundly tilted in their favor that it is essentially a sure thing.
Exactly.
And Naval takes this mathematical reality of compounding and expands it way beyond money. He applies it to human relationships. He has this heuristic. All self-help boils down to choose long-term over short-term.
So how does he apply that to relationships specifically?
Well, he points out that trust is a compounding asset. So if you play long-term games with long-term people, the compounding effect of trust removes almost all the friction from your life.
Oh, that makes sense.
Right, think about doing a business deal with someone you literally just met. You
Yeah.
need lawyers, you need 60-page contracts, you need escrow accounts, you have to constantly monitor them. The friction is massive.
Because there's zero trust.
Exactly. But if you have done business with someone for 20 years and you know they are playing a long-term game, you can execute $1 million deal with a handshake over lunch.
Because neither of you is willing to trade 20 years of compounded reputation for a quick short-term payout.
Right. The trust is the lever that allows you to move faster. But this is incredibly difficult to maintain because the world is actively trying to pull you out of the compounding curve every single day.
It is. And Buffett has a rather cynical but highly accurate analogy for this. He basically describes the modern stock market, and by extension just modern capitalism, as a church with a casino attached.
I love that analogy. The church represents the slow, compounding, long-term wealth building, right? It's quiet, it's disciplined, it requires absolute faith in the math.
And the casino represents the hyper speculation,
Oh.
the day trading, the 0 days to expiration options, the crypto pumps. The casino is loud, it's flashing, and it's offering immediate gratification.
And what we see constantly is people wandering out of the quiet pews of the church and walking straight into the casino.
And Morgan Housel provides the psychological diagnosis for why this happens. It's almost entirely driven by FOMO, the fear of missing out.
Oh, yeah.
Housel argues that the absence of FOMO is perhaps the single most important financial skill a human being can possess.
Because if you are patiently compounding your money at, say, 8% a year, and your neighbor suddenly buys a Ferrari because they got lucky on a highly leveraged speculative bet, the psychological pain is intense.
It's agonizing.
Yeah.
And if you lack the discipline to stay in the church, you will liquidate your compounding machine, run straight to the casino, and almost certainly blow yourself up.
You literally break the exponential math right before day 29. You reset the entire algae bloom.
Exactly.
So to survive long enough for compounding to actually yield results, you have to be able to navigate that psychological chaos. You have to endure risk, and you have to make impossibly hard choices under intense pressure.
Right.
Which shifts our investigation into how these thinkers engineer their decision-making.
Well, let's start with how they actually perceive risk. Because Housel frames this in a way that completely alters your relationship with failure.
Go on.
He talks about the psychological pain of market crashes or, having a terrible quarter in your business or losing a key client. Most people view volatility and loss as a fine.
Like a speeding ticket. You did something wrong, you were reckless, and now you are being actively punished by the universe.
Right. But Housel says it is not a fine, it is a fee. It is the price of admission.
Ah, the Disneyland analogy.
Exactly. If you want to go to Disneyland and ride the rides, you have to pay $100 at the gate. You don't get angry at the ticket taker and feel like you're being punished for showing up. You accept the fee in exchange for the experience.
Right.
Housel argues that if you want the outsized exponential returns of long-term compounding, the entrance fee is psychological pain, uncertainty, and periodic financial drawdowns.
So once you reframe a market crash or a business setback from a fine you're desperately trying to avoid to a fee you willingly pay for long-term growth, your entire emotional response just stabilizes.
It does. And regarding what kind of risks to actually prepare for, Housel's adamant about the difference between prediction and preparedness.
This is a crucial distinction because risk, by its very definition, is what you do not see coming.
Exactly.
Yeah.
You can't predict a global pandemic. You can't predict a container ship getting stuck in the Suez Canal and paralyzing global supply chains. You can't predict a sudden geopolitical war that spikes energy prices overnight.
So therefore, spending all your energy trying to predict the specific catalyst of the next crisis is just a fool's errand.
It's completely wasted energy. Instead, Housel and the Berkshire team focus entirely on preparedness. You build a balance sheet, whether it's Berkshire's $380 billion or just a listener's personal 6-month emergency fund that is designed to absorb a shock you couldn't possibly forecast.
You survive the unpredictable by being universally robust. But survival isn't just about money, it's about mental bandwidth. When you are absorbing those shocks, you have to make decisions rapidly. And Hormozi introduces a framework here that I want to dissect because it is fascinating, but I also see a major potential flaw in it.
Okay, let's hear it.
So he talks about anxiety cost.
Yeah.
We're all familiar with opportunity cost, right? The capital you lose by choosing one investment over another. But anxiety cost is the mental energy drained by unmade decisions.
Right. It is the weight of open loops. Every time
Yeah.
you wake up and think, I really need to fire that toxic employee, or I really need to kill this failing product line, and you delay the decision, you are paying a literal tax on your cognitive bandwidth.
Your brain is basically running that process in the background, draining your battery.
And Hormozi shares a mathematical hack for this. He suggests shifting your default decision-making timeline. Instead of saying, I'll think about this and decide by the end of the week, you force yourself to decide by the end of the day.
And he charts out the speed advantage of that. If a normal person has 4 major strategic decisions to make, and they take a week for each one, they have consumed a month to make 4 moves.
Right.
If Hormozi forces decision 1 on Monday, decision 2 on Tuesday, decision 3 on Wednesday, and decision 4 on Thursday, he has moved through a month worth of strategic progress in just 4 days. He claims this is how you move 30 times faster through life.
Because you refuse to pay the anxiety cost of delay.
Okay, but let me stop you there, because here is my pushback. If I am running a complex business or managing my entire life savings, and I force myself to make a massive structural decision by 5:00 p.m. just to clear my mental inbox, aren't I risking a catastrophic mistake?
That's a fair point.
Like, how is moving faster mathematically better if the accuracy of my decisions plummets because I didn't take the time to actually analyze the data?
That is the exact vulnerability of pure speed. And it is exactly why Hormozi's operational velocity must be paired with Naval Ravikant's architecture of judgment.
Okay.
Naval argues that in an age of infinite leverage, where a single click can literally deploy millions of dollars or push a software update to millions of phones, the impact of a decision is magnified infinitely.
Right.
Therefore, the actual physical execution of a task is cheap, but judgment is the most highly compensated skill on Earth.
Okay, so if you are steering a massive cargo ship, turning the wheel is physically easy. But knowing exactly when and where to turn the wheel is what prevents the ship from hitting a reef.
Exactly.
And if your judgment is just 10% better than the next captain's, society will pay you hundreds of millions of dollars for that slight edge in accuracy, because the leverage applied to that judgment is so immense.
Exactly. So to answer your pushback, you can move at Hormozi's speed, deciding by the end of the day if you employ Naval's heuristics to ensure accuracy.
Okay, what are the heuristics?
Well, Naval provides incredibly rigid rules to filter decisions rapidly. The first heuristic is, if you can't decide, the answer is no.
Wow, that clears the inbox immediately.
It does. If you are agonizing for a week over whether to hire a specific person or whether to marry someone or whether to invest in a startup, the default is no. The opportunity must be a screaming, undeniable yes. If it requires a pro and con list and a week of intense deliberation, it is a no.
That's powerful. And his second heuristic?
His second one is even more demanding, and it goes against our entire biological programming. Naval says if you have 2 fundamentally equal choices, choose the path that is more painful in the short term.
This sounds terrible. Why would you do that?
Well, the mechanics of why this works are rooted in evolutionary biology. The human brain is naturally wired to avoid immediate pain to ensure short-term survival.
Right, running from the lion.
Exactly. Because of that hardwiring, when faced with a difficult choice, our brains will literally hallucinate. We will magnify the short-term pain of the harder choice, trying to trick ourselves into taking the easy way out.
Give me a practical example of that hallucination.
Let's go back to firing the toxic employee. The short-term pain is having a terrible, awkward conversation, dealing with potential legal HR paperwork and, temporarily losing their productivity.
So the brain just screams, avoid this.
Right. But the easy way out, which is keeping them, almost always kicks the can down the road. The long-term pain is a completely destroyed company culture and the loss of your absolute best talent who leave because they refuse to work with a toxic person.
So by aggressively, actively choosing the short-term pain, you cancel out your own cognitive bias. You basically take the hit today to prevent the catastrophic compounding of pain tomorrow.
Yes. And there's one more shared mental model for decision-making that bridges the gap between Alex Hormozi and the Berkshire Hathaway team.
What's that?
Both actively rely on Charlie Munger's famous doctrine. Invert, always invert.
Which is just a masterclass in lateral thinking. Explain the mechanics of inversion for the listener.
So our default approach to problem solving is always forward-facing. We ask, how do I achieve X? Let's say you ask, how do I grow this business?
Right, which is a massive, incredibly complex question with thousands of variables. It's very difficult to pinpoint the right answer.
Exactly. Inversion flips the camera. Instead of asking how to succeed, you ask, what are the absolute guaranteed ways to destroy this business?
You literally list out the failure modes.
Exactly. You write them down. How do we go bankrupt? Well, we alienate our best customers. We make the product confusing to buy. We bleed cash on unmeasured advertising. We treat our employees so terribly that they steal from us. We take on variable rate debt.
And suddenly your strategy becomes incredibly clear.
Your strategy just becomes do the exact opposite of that list. Avoiding stupidity is much easier and often much more profitable than attempting to seek brilliance.
If you just systematically invert every problem and rigorously avoid the failure modes, success basically becomes the natural byproduct. That is a deeply liberating way to approach strategy. But I think it brings us to a really harsh reality here. You can perfectly execute everything we have discussed so far. You can build massive permissionless leverage. You can have the endurance to wait out the compounding curve. You can optimize your anxiety cost, apply brilliant judgment, invert every problem.
Yeah.
But if you lack one specific structural element, you capture almost none of the value you create. This is the final pillar of the architecture: ownership, independence, and playing your own game.
And this is exactly where Naval Ravikant draws a permanent line in the sand. He states it as an absolute unbreakable law of wealth. You will never get rich renting out your time.
Never. Even if you are a highly specialized surgeon charging $1,000 an hour.
Because even the surgeon is bound by the laws of physics. They cannot work more than 24 hours a day. Their inputs are permanently shackled to their outputs.
Right.
Furthermore, when you rent your time, the person paying you is always factoring in a margin. They are paying you less than the value you create. Otherwise, they literally wouldn't hire you.
That's just capitalism.
Right. To gain true financial freedom, Naval insists you must own equity. You must own a piece of a business, intellectual property, a brand, or an asset class.
And Hormozi validates this from the perspective of the business owner. He addresses the friction between labor and capital, because employees often feel they are doing all the day-to-day work while the owner reaps the massive financial reward.
But Hormozi points out that the equity holder, the entrepreneur, is the one who absorbed the initial outsized risk.
Right. The owner signed the personal guarantees on the lease. The owner funded the payroll when the company was actively losing money. The owner eats the catastrophic losses if the market shifts.
And because the equity holder takes that asymmetrical downside risk, the math demands they receive the asymmetrical distributions when the company succeeds. Equity is basically the financial reward for ultimate accountability.
So Naval distills this entire philosophy of leverage and ownership into this two-word mandate: productize yourself.
It sounds like a bumper sticker, but it is actually a really dense operational formula.
Let's break down the two words.
Okay, the word yourself is the anchor of authenticity and accountability. Naval argues that you must lean heavily into your specific knowledge, right? The weird obsessions, the unique skills, the specific intersections of talent that you possess.
Things that feel like play to you but look like grueling work to everyone else.
Exactly. When you're operating as your authentic self, no one can compete with you. You have a monopoly on being you.
And the word productize is the engine.
Yes. Productize is the mandate to take that unique you-ness and wrap it in the leverage we discussed earlier. You wrap your specific knowledge in code, in media, or in capital, so that it can be distributed to millions of people without requiring your physical presence.
But as you are building this productized version of yourself, right, as you are accumulating equity and navigating all these risks, Morgan Housel provides a really crucial warning. He highlights a massive psychological trap that destroys people who are otherwise brilliant at all of this.
Yeah, this is so important. He cautions against the supreme danger of taking cues from people who are playing a different game.
This happens constantly in finance and business, and it is catastrophic. I actually thought of a mechanical analogy for this while reading his transcript.
Oh, let's hear it.
Imagine you are running a marathon. You are at mile 15. You are managing your heart rate, conserving your glycogen, monitoring your hydration. You are executing a highly specific long-term strategy.
Right, playing your game.
Suddenly, a guy jumps onto the track right next to you, and he is sprinting at a dead run. If you look at him and your ego flares up and you think, oh man, I'm falling behind, I need to match his pace, what happens?
You blow out your legs, spike your heart rate, and collapse in like 60 seconds.
Because you didn't realize that guy was only running a 100-meter dash. He's playing a completely different game with completely different rules and a different finish line. But because you were on the same track, you let his actions dictate your strategy.
And Housel points out that in the financial markets, this happens every single day. You have a 22-year-old day trader using margin and options to try and double his money by Friday.
He is sprinting the 100-meter dash.
Right. And then you have a 55-year-old parent methodically buying index funds to ensure they can retire safely and pay for a child's college. They were running the marathon.
But they are both buying stocks on the exact same exchange, watching the exact same ticker prices.
And if the parent starts taking emotional cues or strategic advice from the day trader, the parent will completely ruin their family's financial future.
You have to aggressively define what game you are playing and then put blinders on to everyone else.
Housel actually shares a brilliant, highly personal example of this that basically drove financial advisors crazy.
Right, the mortgage story.
Yeah. Housel had a fixed-rate mortgage on his home at roughly 3.2%, and he decided to take a large chunk of his liquid cash and just pay off the mortgage entirely.
Which, mathematically, on a spreadsheet, is a terrible decision.
It is entirely suboptimal. Any first-year finance student would tell him that instead of paying off a 3.2% debt, he should have kept the mortgage, put that cash into an S&P 500 index fund, and earned an average of 8 to 10%.
He voluntarily left a massive amount of compounding money on the table.
But Housel defends the decision. Why? Because Housel realized the specific game he is playing. His game is not titled Maximal Spreadsheet Returns. His game is titled Maximal Independence and Peace of Mind.
Wow.
Waking up every morning knowing that he outright owns the roof over his family's head, knowing that no bank can ever foreclose on him no matter what happens to the economy or his income. That provided a psychological dividend that utterly dwarfed the financial opportunity cost.
He identified his metric for success, which was psychological independence, and he executed against it, completely ignoring the rules of the spreadsheet game. So when you zoom out and look at all of this, when you assemble the gears of leverage, the exponential math of time, the architecture of decision-making, and the absolute necessity of ownership and independence, you see the complete Nexial theory.
We have spent the last hour pulling apart the mechanics, but now we really need to synthesize them into a unified framework for the listener.
Let's do it.
When you look at the intersections between Naval, Hormozi, Housel, and Buffett, you don't just see a list of tips. You see an interlocking engine where every part requires the others to function.
So let's walk through how this engine actually runs, basically the top 10 ideas.
Right. The foundation of the entire structure is number one, the realization that equity truly outranks wages. Naval and Hormozi agree that you cannot rent out your time and expect to scale. Ownership is the mandatory gatekeeper.
But once you realize you need ownership, you have to build something. Which brings us to number 2, choosing permissionless over permission tools. This gives you the unprecedented speed of the modern world. Code and media allow you to scale that equity without asking for capital or managing an army.
But that speed means absolutely nothing if you don't survive, which is number 3. Naval's leverage requires Buffett's understanding that endurance outranks peak returns. You can build the greatest software company in the world, but if you cannot stay in the game long enough for the algae to cover the pond, the leverage is useless.
And to endure, you have to accept number 4. Housel's premise that volatility is a fee, not a fine. The psychological pain of running that business, of watching your net worth fluctuate, is the literal cost of admission to the compounding curve.
And to manage that pain and keep the machine running, you need number 5, Hormozi's operational rhythm. You realize that patience is an action, meaning you execute the boring daily plan while actively ignoring the delayed outcome.
Which you can only do if you possess number 6, judgment as the supreme multiplier. You use Naval's heuristics, defaulting to no and actively choosing the short-term pain to make rapid, accurate decisions.
And number 7, you use Munger's technique to invert the timeline. You look at how to destroy your wealth so you can systematically avoid those exact behaviors.
Ultimately, you realize number 8, compounding is universal. It doesn't just govern the capital in your business, it governs your reputation and your relationships.
And in the moments of chaos, when the market is screaming at you to do something, you rely on number 9, the hardest skill of all, inaction as an active strategy. You learn to sit on your hands like Berkshire, sitting on billions in cash, just waiting for the undeniable pitch.
And finally, number 10, the only way to maintain that discipline, to not get pulled into the casino, is to aggressively play your own game. You define your personal metrics for success, and you become entirely immune to the status games of the sprinters running next to you.
That is the complete architecture right there. It is this beautiful interlocking system of physics, psychology, and math.
It really is. And it leaves us with one final, deeply provocative question for you to consider before we wrap up today's deep dive.
Right. If you accept this synthesis, if the mechanics of wealth and freedom are largely a solved equation,
Which they are. It's a universally agreed upon mix of leverage, equity, endurance, and precise decision making.
so what is the invisible script in your own psychology that is forcing you to ignore the math?
Exactly. If the blueprint is sitting right in front of you, what fear, what bias, or what short-term status game is keeping you pedaling in first gear?
Understanding the physics of the skyscraper is entirely different from having the courage to actually pour the concrete.
Take a deep look at your own timeline, your inputs, and your daily friction this week. Are you renting your time, or are you building a lever? Thanks for joining us on this investigation into the Nexial Theory. We'll see you next time.